Okay, and then abandonment, similar again internationally in the U.S. There's not really differences here. So let's go back. I've got successful efforts and full costs here. For the $50,000 property in the unproved property account for Block A, we impaired it $5,000, and now later on, guess what? We decide to abandon it. Things don't go well. We've only impaired it $5,000, but we decide to abandon it. Under successful efforts, we're going to have an expense in our income statement, something like abandoned property expense. I mean, every company, again, can have your own names for your accounts, but it's going to be expensed through your income statement. So $45,000 is my net book value because I have $50,000 minus an allowance of $5,000. Allowance for impairment was my contra asset. Remember that under successful efforts, that $5,000 that I put in that allowance already went through the income statement when the allowance was set up. That $5,000 already went through the income statement. So now only another $45,000 goes to the income statement when I'm abandoning. So the 50 minus the allowance, that's my book value, 45, the allowance of 5. That 45 is going to be abandoned property expense. It's going to reduce income by $45,000 on my income statement. And then my net unproved property asset is decreased on the balance sheet. That property is coming off the balance sheet. Its net book value is $45,000. Now, again, I do have to take both the contra asset and the asset account off the balance sheet. So the asset of 50 will come off the balance sheet, and the contra asset of 5 will also come off the balance sheet. That's a net asset decrease. And this is really what I want you to know. What's the net amount that's going to be decreased on the balance sheet? $45,000. Under full cost, basically looks the same, except now we don't expense this on the income statement again. Abandoned property asset. We have an asset, abandoned properties. Again, those are going to remain capitalized as asset. So the abandoned property asset account is increased on the balance sheet. And net unproved property is decreased on the balance sheet. This property comes out of unproved. That kind of shows that we're not working on it anymore, right? It comes out of that asset. Again, we're going to close the asset and the contra asset. And instead, it's going to go into an abandoned property asset, but it's still an asset. We're taking the net unproved property asset off the books by closing out the allowance and the asset account. That decreases our unproved property for this asset by $45,000, but now it's going to go into an abandoned property asset. So it's still capitalized. This abandoned property asset is not excludable too, right? Because we know we're not going to get reserves from this field. So that is not an excludable amount when I'm doing DD&A with exclusions. Okay, so let's look at abandonment of individually insignificant or grouped property. So again, we have this $300,000 group of unproved properties, and we're going to say we have an allowance for impairment of $75,000, right? We set that up, or we brought it up to $75,000 in a few slides earlier. And we decide to abandon one of the properties in the group. Now, the group's still there. We're just abandoning one of the properties, right? The acquisition cost of that property was $10,000. So whether or not your successful efforts are full cost, what's going to happen is really the net group asset on the balance sheet is not going to change. I'm going to take off the unproved property. In other words, I'm going to decrease my unproved property group by $10,000. So that's going to bring this balance to $290, from $300 to $290, this balance of the unproved property account. It's going to go from $300 to $290. I'm going to take that 10 out of there, but I am also going to take 10 out of the contra asset account. So the contra asset account is going to go from 75 to 65. Well, before we had 300 minus 75, that's 225 net book value. Now we have 290 minus 65. That's still 225 net book value. So our net book value doesn't change for the group. All we did is really charge this unproved property against the contra asset account. Now remember, if your successful efforts, why are we not expensing it? Well, that $75,000 in that contra account has already been expensed in prior periods. If you're full cost, it's already gone into an impairment account in prior periods, an impairment asset. So I'm charging that against that allowance, and the net group value does not change of the asset, so there's no change. Now, the best thing, of course, is that the field becomes proved. That would be great, right? So if we go back to our individually significant property with $50,000 in the unproved property account and the allowance for impairment of 5, that's a net book value of 50 minus 5 or 45, the property becomes proved. What's really going to happen, I can only move the net book value to proved property. I can't reverse an impairment. I can only move the net book value of 45 to proved property. So the proved property asset is increased on the balance sheet. Same whether successful efforts or full cost here. The proved property asset is increased by $45,000. Net unproved property is decreased by $45,000. And that's done through a decrease of unproved property of 50, but then a decrease to the contra asset, which reduces assets, right? I'm decreasing that contra asset on the balance sheet of 5. So I've reduced an asset of 50, but I've reduced a contra asset by 5. That's a net reduction on that unproved property of 45, because I've reduced the asset by 50, but I've also reduced the contra asset, the allowance, by 5. So that's a net reduction in unproved property of 45, and then it's just really being transferred to proved property. So I'm taking the asset out of unproved property and just moving it to proved property. Okay, now what about the group? Let's assume we've got that group, $300,000. Let's assume the allowance for impairment, $75,000. Now we've got a property for $10,000 that's proved. So it needs to go out of the group. Again, successful efforts or full costs, really all I'm going to do, the group unproved property is decreased by $10,000, and then this is going to go into a proved property asset of $10,000. So it's going to go into a separate asset account, proved property field C, whatever it is. So the proved property asset increases $10,000, but the group unproved property asset decreases $10,000. And again, if only half of the property is proved, as you know, sometimes in some fields you may be working in one area of the field. You might prove part of the field, but not the whole field, because the field is large, let's say, and you haven't really worked in the other half. So maybe the northern half, the engineers say, are proved, so only 50% of the field is proved. Well, then just move $5,000 from the unproved property asset, decrease that asset on your balance sheet, and move it to the proved property asset on the balance sheet. We'll leave the other $5,000 in unproved property because we're still planning to work that part of the field. Again, same under full cost or successful efforts. Okay, so that was unproved property. What about producing properties? Well, producing properties are cash-generating units. And there are some overall rules for the impairment of cash-generating units. So these rules that we're following are not just for the oil and gas industry. We didn't use these rules for unproved property because unproved property, they're not cash generating, and we don't know if they're ever going to generate cash because they're unproved. We have no tangible reserves there. We have no proved reserves. We don't know if we're ever going to get cash from that. So we say unproved property is not a cash generating unit, and therefore we have separate rules for unproved property. If you want to look up the specific rules, you can look in the portfolio and you'll see the references to those rules. But when we get to proved properties are really now, they're cash-generating units. So we can follow the general guidelines for all industries for impairments of cash-generating units. Now let me say that successful efforts companies follow this. After we look at this, we're going to look briefly at what we call the full cost ceiling test. Those of you who are in full cost companies have probably heard of this. The SEC has a special test for full cost companies called the full cost ceiling test. It is much more rigorous than this test, and therefore you're going to write down more often under that test. So that's a more rigorous test, and so you wouldn't really need to do this one because that one is going to write down probably more than this one, to tell you the truth. So you're not doing this one because the SEC says you have to do the ceiling test. Now if you wanted to do both tests just to make sure, you're allowed to, but basically full cost companies, you have to do the ceiling test. This one's kind of an optional second test if you wanted to see there was more write down, but there really shouldn't be. If you're doing the ceiling test, that's a more rigorous test. Okay, so U.S. and international are a little bit different here. First of all, again, I don't have to be in the oil and gas industry. Any industry does this. So we're going to look at the lowest level for which I can identify cash flows. Again, successful efforts. Lowest level for which I can identify cash flows. So if I am an automobile manufacturer and I have 3 plants in the U.S., I can probably identify cash flows by plant and impair by plant. So I have 3 asset groups, or 3 what we call cash generating units, or CGUs you might hear referred to. Well, in the oil industry, or oil and gas upstream industry, basically we can identify cash by the field. We know how much we're spending there. We know how much revenue we're getting. Again, these are producing properties. Or they're at least proved properties. So we know how much revenue we're getting or we're expecting to get, and we know how much we're spending. So we can generate cash by field. Now, you could make cases for other things because, again, this statement does not have specific rules for the oil industry. When this statement came out, I believe it was first 1997 was the first year that it was required, I believe. But when it came out, you know, the industry had to make a lot of decisions about what they were going to do to apply this rule. And at the time, I and someone else did a survey of U.S. controllers for U.S. publicly traded companies that had to do this. And we asked them a lot of questions about how they were going to apply these rules. And we asked, what's going to be your cash generating unit? Well, by far, I mean like 99%, right? It's going to be the field. And that's kind of obvious. You know, some of the questions weren't as obvious, but that seems kind of obvious. We asked it anyway. And then after 1 year after they had actually implemented, we then asked, how did you actually implement? So what did you plan to do? We took one survey before implementation, and we took another survey a year after implementation. And there were some differences, but by far, field, that didn't change. Field was the cash generating unit. Okay, so you've got your field. Now, your successful effort, so you've got a book value for your field, right? Because you're doing DD&A by field. Full cost. Can't really get a book value for a field very easily because you're not doing DD&A by field. But successful efforts can. So, first of all, I've got kind of US 3 stages. Some people call it 2 stages because they don't count number 1 as a stage. You know, whatever you want to call it. But basically, let me go back, since I'm remembering this now. Basically, in this test for proved properties, I do not have to do this annually. Now, for unproved properties, you have to do that test annually. You have to look at it annually because the value of unproved property is very uncertain, and that can change a lot from year to year. But this test, you do not have to do annually. You only have to do it if the event or circumstances indicate that a decrease in value may have occurred. That's the only time you have to do it. You don't have to do it annually. Now, you're allowed to do it annually on every field if you want to. Certainly allowed to. But you don't have to. So that was one of the other things we asked. What events or circumstances, you as controllers, what are you going to look at? What would be common events or circumstances? And again, some seem kind of, you know, what we were expected, but obviously reserve estimates changes. Well, this is a proved field. Why should reserve estimates change? Well, there's lots of reasons reserve estimates change, right? Proved reserves. We're talking generally proved reserves. The decline rates are going much faster than we thought. You know, we really thought we were going to get more out of this reservoir. Now it looks like, just engineering-wise, looking at the pressures and so forth, we're not going to be able to get as much out as we thought. So even though we had this much in proved reserves, we're going to write that down by 20%. That might be a trigger event. But what happens when the price of oil and gas go down? Our proved reserves are based on prices. right, at $45 a barrel, how much can I do to get the oil or gas out of the ground? You know, I have to think of the economics of that. If I'm only going to get $45 a barrel, I can't go to extreme measures to get oil and gas out of the ground. But if I can get $1.50 a barrel, I'm going to do a lot more to get that oil and gas out of the ground. It's economic. So at $1.50 a barrel, I'm going to have more proved reserves than at $45 a barrel or $50 a barrel, right? And we see these big differences having happened in this last year, right? So, well, then maybe not 150, but, you know, from 100 down to 45 and bouncing around. So, as our prices change, unless we can really justify those being temporary changes, and that's difficult to do. I mean, forecasting prices is obviously difficult, but as the engineers, and some of you are engineers, when you're doing your estimation of reserves, you're using some kind of internal price forecasting, right, to do that. Prices go down, you're going to have less reserves. So that might be a trigger event. So again, I don't have to do this every year, but I'm going to look at the fields. If there's a trigger event, then maybe I need to look at this field. Proved reserves have been reduced. I'm going to then look at the field's book value. BV stands for book value. Book value is what have I spent on the field? Leasehold, wells and equipment. It's what's capitalized, not, again, this is successful effort. So if you've, not G&G, because we've expensed that, right? Not exploratory dry holes, because we've expensed that. But what are the assets on my books for this field? Leasehold. All my wells and equipment that have been capitalized, have been assets. Minus any accumulated DD&A, right? Because that's going to reduce my book value. So what's my assets on the field minus accumulated DD&A, I'm going to have that book value. And then I'm going to compare that to undiscounted future net cash flows. Undiscounted. So again, obviously those of you who work with this, there's computer programs out there. You're going to put in for the field, you know, future production from now till whenever you think production's going to end, and you're going to put in your forecast prices, you're going to put in your forecast cost, and you're going to get undiscounted, basically net cash flows, you know, revenue minus cost. And if my book value, or let's say it this way, if my undiscounted cash flows are greater than book value, so I'm at least getting the book value back. Now, I'm not discounting. I'm not considering the time value money. I'm at least getting that money, that investment back. So if the undiscounted cash flows are greater than book value, then I stop. Undiscounted cash flows are greater than book value, there's no write-down under U.S. GAAP. We're on U.S. GAAP. But if undiscounted cash flows are less than book value, then I need to write down the field. But not to undiscounted cash flows, because that's not really a fair value. I need to write down the field to fair value. Well, what's fair value? Fields aren't traded. I can't look in the Wall Street Journal and see what the field is trading for today. So book value is by far, again, 97, 98% of companies are going to get fair value by taking those undiscounted cash flows, fair values, and discounting them. So discounting them at the company at an appropriate rate for the company's level of risk, right? Company's kind of cost of capital thing. So once I discount those, then that gives me an estimate of fair value. Now because this wasn't written for the oil industry, it doesn't have specific oil industry rules. So there is a lot of discretion here. So for instance, which reserves do I use? Well, I'm obviously going to use proved reserves, but I could put probable in there. I could put some probable. I could put all probable. I mean, the rules doesn't say. It needs to be reasonable. Again, the auditors need to look at it. The SEC might question it. But it needs to be reasonable, but there's not a specific rule that says you can only use proved reserves. This is one of the few places in U.S. GAAP where in our accounting guidelines, we're allowed to use probable reserves also if we want to. We don't have to. So there's discretion there. And of course, you're not dictated as to what you're going to forecast your future prices as. You're allowed to use your own forecasting. Now, I'd say it has to be reasonable again, but that's going to differ from company to company. There's no rule that says you have to use an average price for the year here. No, you can use your own forecast prices. So to an extent, you have discretion in applying this rule. Now, again, how you want to apply it is somewhat of a management decision, but it has to be reasonable, and it has to pass muster, right, with the auditors and the SEC. So I tend to be more conservative. I'd say, prove reserves, maybe some probable, but probably not all of them, though. Some risk-adjusted amount. And my forecast prices, assuming my forecast prices and cost are reasonable. Okay, now the thing about international is, again, you're going to look at the field. You don't have to do it every year, but if events or circumstances indicate a loss in value has occurred, then you need to look at that field. So that's the trigger event. But they're not going to look at undiscounted cash flows. They're not going to do this step 2 under U.S. GAAP. They're going to compare the book value of the field directly to fair value, which is usually discounted cash flows, right? So they're going to go right from book value to discounted cash flows and write down if needed. So what's going to happen? International GAAP is going to have write-downs more often than U.S. GAAP, because there's going to be many times when undiscounted cash flows are larger than book value, so we don't write down in U.S. GAAP. But discounted cash flows, if we discounted them, they're less than book value. So in those times, we would not write down under U.S. GAAP because undiscounted cash flows were greater than book value, but we would write down under international GAAP because discounted cash flows are less than book value. Okay, now let's go to the next slide and look at some numbers. Let's say we have a field with a book value of $3,100,000. We have scheduled out our future cash flows, net cash flows, future revenue minus future cost. Our undiscounted future net cash flows are $3,200,000. $3,200,000 is greater than $3,100,000, so we're not going to write down under U.S. GAAP, no write down. However, International GAAP doesn't look at that undiscounted amount. International GAAP goes right from the $3,100,000 and compares it to discounted cash flows. When I discount those cash flows, it comes out to $2,100,000. So under International GAAP, I'm going to have $1 million write down. That is going to be a loss expensed on my income statement. Again, I'm successful effort. It's going to be a loss expensed on my income statement. Going to reduce income. And the net field asset is going to be decreased on the balance sheet. Usually companies will increase accumulated DD&A, which is a contra asset, in order to get to that net field asset being decreased on the balance sheet. So if I increase a contra asset like accumulated DD&A, or I could have a separate contra asset like accumulated capitalized cost reduction or accumulated impaired field cost, some contra asset is going to reduce the net field asset on the balance sheet by $1 million. Now again, U.S. no write down, but at the bottom we show if undiscounted cash flows had been $2,000,009, then I would have written down under U.S. because $2,000,009 is less than $3,000,001, but I wouldn't have written down to $2,000,009. I would have written down to fair value, which goes to the $2,000,001. So if undiscounted cash flows had been $2,000,009, there would have been a $1 million write-down under U.S. GAAP with the same effect, a loss on the income statement, the net field asset decreased on the balance sheet. So again, I wouldn't write down to the $2,000,009. That just tells me I need to write down. Now I need to look at fair value, which is discounted cash flows of $2,000,001, and that's what I'm going to write down to. Now that sounds a little odd, so why are we writing down more often under International GAAP? Well, this may be one of the reasons. Impairment reversals. To be conservative, we tend to be pretty conservative in the U.S. Once we have impaired a field, it cannot ever be reversed. That impairment is never reversed. We impaired this field, and guess what? prices went up, reserves went up, or now we hit another development well, it's looking really better, and we revise our estimate of reserves upward. Well, we don't reverse any old impairments. Once it's impaired forever under U.S. GAAP. However, under international GAAP, you can reverse impairment, and not only can you reverse impairment, you are required to reverse impairment if the indicators are there. Now, you need backup, right? I can show that my reserves were revised because of these circumstances, right? So I am required to reverse under international GAAP if the circumstances indicate that it's needed. However, reversal is limited to an amount that would bring the book value of this field to the lower of the fair value today, or what the book value would have been currently if impairment had not been taken. So let's just say I impaired 3 years ago. This is international GAAP. When I impaired, that reduced the book value of the field. So that book value was going into my units of production, DD&A. So my DD&A was different. It was lower because I impaired the field, so I had lower book value going into my DD&A calculation. Well, if I had not impaired, now I have to go back and say 3 years ago, if I had not impaired, what would my DD&A have been 3 years ago, 2 years ago, 1 year ago? What would the book value be today if that impairment had not been taken? Because my DD&A would have been different every year. That's the maximum amount that my asset can be written back up to. So if the reversal is indicated for more than that, I have to max it out at what book value would have been if I had not taken the impairment 3 years ago. Now, again, that means I would have a different DD&A for each of those last 3 years, so I have to go back and compute that. That's my ceiling to what I can write that asset back up to. And that does take quite a bit of time sometimes, because sometimes you have to go back, I impaired 3 years ago, but I also impaired 7 years ago, and I have to go back all the way to 7 years ago. What would happen between 7 years ago and 3 years ago, and then what would have happened from then on to today? It can be time-consuming. Okay, now let's look at the full cost ceiling test. It can be a very involved test. So I'm going to somewhat overview it here. I want you to get an overview or an idea of what it is. If you look at full cost company, or if you work for a full cost company, you may be more familiar with this. But again, my cost center is a country or region of countries. I'm going to compare the book value of that whole country, right? Everything that's capitalized. My impairments are capitalized. My abandoned properties are capitalized. My unproved properties are capitalized. My proved properties are capitalized. Minus accumulated DD&A, that kind of thing. What is the book value of my cost center, my whole country? And I'm going to compare it to a ceiling. This is an SEC written rule. The ceiling consists of, first I'm going to take the present value of future net revenues. Now, when I use future net revenues, this is why this is a stricter test. I cannot forecast prices like I could under the other tests with successful efforts. I cannot forecast prices now. I have to use the 12-month average price for the year. And I'm going to get that by taking the first day of the month price for each of the 12 months of the year. So January 1st, what was the price in this field that I was getting? February 1st, what was the price for, sales? March 1st through December 1st, divide by 12. So I've got to use that average price, and I cannot forecast any changes to that price. So when I get my future net revenues, I have to assume that average price that for this year is going to stay in effect forever. And I have to use a 10% discount rate. In today's world, 10% is kind of high. And I can only use proof reserves. And here, you cannot use any probable reserves, and I kind of had a choice to use that under successful efforts. I cannot include probable reserves here, so it's a much stricter. Then I'm going to add the cost of any unproved properties that are being excluded, right, because I can exclude unproved properties. And if there are unproved properties that are not being excluded or being included, I need to include the lower of cost or market of those properties. So LCM is lower of cost or market. And again, I've got to have some kind of appraisal idea or some kind of determination of what that fair value is. So the lower of cost or market of unproved properties needs to be included, minus the tax difference on the above. Now, we're not really getting heavily into tax in this class. I am not a tax person. Truly, I'm a financial reporting person. But as we know, kind of like when I talked about DD&A, tax has their own way of doing things. DD&A is completely different for tax than it is for financial reporting. So there are differences between the way we do things for tax and the way we do things for financial reporting to the SEC. And that creates tax differences. So and we're not going to get into deferred taxes in here, but I just kind of have to mention it here because it is part of the tax, or it is part of the ceiling test. Any tax differences created from the above then need to be subtracted. So as my example, and again, I'm giving you all this information. Probably the hardest part in the company is gathering all that information and putting it all together, because this is a whole country. You might have tons of assets in this country, right? So Peters Oil classifies the U.S. as a separate cost center. The net book value of all capitalized costs in the U.S. is $270 million. The present value of future net revenues from proved reserves only in the U.S. using the current year 12-month average price, current cost, and a 10% discount rate is $290 million. Peters excludes all unproved properties from the calculation of DD&A. The cost of the unproved properties excluded from the depletion calculation are $42 million. The income tax effect based on the differences between book and tax basis of the properties is $78,530,000. So this is what our final test would look like. The present value of our future net revenues is $290 million. We're going to add the cost of the unproved properties not being amortized. That's $42 million. All of my unproved properties were in that category, so I have zero for low of cost or market of unproved properties that are being amortized for right now, minus my tax effects of $78,530,000. That's a ceiling of $253,470,000. But my asset is at $270 million, so I need to write down by $16,530,000. Now, I'm not showing the complete entry here if any of you work with it, because you do have to adjust your deferred tax accounts, and I think that's beyond the scope of this class of what I want you to get out of here. I'm not trying to teach you deferred taxes. I'm trying to teach you industry accounting. So what we're going to end up with is a net expense on my income statement of $16,530,000, because I do have to write this down. And this is expensed, right? This impairment is not an asset. It is expensed, because the SEC wrote this rule to say, okay, if you're going to use full costs and you're going to capitalize all this stuff, right, G&G, abandoned cost, everything, if you're going to capitalize all that, we're going to give you a pretty strict rule to follow to make sure that, in our opinion, based on our rule as the SEC, you're not overcapitalized. You don't have too many assets. So this is going to be expensed on your income statement. Got to take a big hit. And then that's going to decrease your cost center on the balance sheet. So your balance sheet assets are going to go down by $16,530,000. Now you can see that in periods with falling prices, like we've had, what happened in 2014? Prices started falling, right, and kept falling. You're going to have very probably some good write-down amounts in those kind of years when prices are low, because you have to use that 12-month average price. You can't forecast any changes to that. And again, you can never reverse an impairment under this test either. Once it's impaired, it is impaired forever, so you cannot reverse that. Okay, that's it for the lecture on impairments. We will also look at the companies a little later and look at their statements.